Every time you swipe your toll tag, money flows, but not where you think it does. In 1956, President Eisenhower signed the Federal Aid Highway Act, and America's interstate system was born. Highways were funded by gas taxes and general revenue. Simple, direct. Then, starting in the 1980s, states began experimenting with something different: toll roads. Today, tolls generate roughly $17 billion annually across the United States. That sounds like a lot, but the question isn't how much is collected. It's where it goes, and why that structure was predictable the moment politicians decided to monetize a road. Let's start with the mechanics. A toll road is a simple concept: you use it, you pay. But the money collected doesn't go into a general fund where legislators can spend it freely. Instead, toll revenue is typically earmarked, locked into bonds, contracts, and operational budgets specific to that road. This creates what economists call a dedicated revenue stream. It sounds efficient, and it is in a narrow sense, but dedication also creates isolation, which raises the next question. If tolls are supposed to fund roads, who actually builds and operates them? Here's where the model splits into two paths. Some toll roads are public, owned and operated by state departments of transportation or regional authorities. Those operate at cost theoretically, but many are private or semi-private through public-private partnerships known as PPPs. Private operators bid to build, run, and collect tolls on a road. In exchange, they get a long-term contract, sometimes 30, 50, or even 99 years. They assume the risk, they also assume the profit, and that's the feedback loop that economists saw coming decades ago. When a private company operates a toll road, their incentive is to maximize revenue. More tolls, higher tolls, more lanes to toll. This isn't malice, it's the design. But it creates a tension. The public needs affordable access, the operator needs profit. And when a contract locks in a 50-year obligation, the operator is betting on traffic volume, inflation, and demand that may not materialize. If traffic drops, they lose money. So what do? They lobby for toll increases, and they lobby for restrictions on competing routes. In several states, toll operators have contractual provisions that prevent the state from improving parallel roads, because free alternatives would cut into toll revenue. This is called a non-compete clause, and it's baked into the contract. The state, in effect, agrees to keep roads worse so the toll road stays profitable. That's not a conspiracy. That's standard contract language that was visible to anyone who read the fine print. Now, who actually profits? The companies that build toll roads are often subsidiaries of larger infrastructure firms, sometimes foreign. Macquarie Group, Australian investment bank, operates toll roads across North America. Spanish firm Abertis runs tolls in the United States. These aren't evil actors. They're simply following the incentive structure the government created. They bid low to win contracts, then extract value through tolls and ancillary fees, and through refinancing debt at favorable rates once the road is built and cash flow is proven. But there's a second profit layer. The investment firms that finance these roads also profit. They buy bonds backed by toll revenue. If the road performs, the bonds pay interest. If the road underperforms, say, traffic is lower than projected, the bonds can default. This happened in 2009 when the Pocahontas Parkway in Virginia, a private toll road, struggled to meet projections. Investors took losses. The road stayed open, but the financial model broke. This brings us to the core tension. Toll roads are pitched as a way to fund infrastructure without raising taxes. Politically, it's appealing. Economically, it's a transfer of wealth. The public pays tolls instead of taxes. But tolls are regressive, they hit lower-income commuters harder as a percentage of income. Meanwhile, the profit flows to investors, not back to the road. A gas tax, by contrast, goes directly into the highway fund. No middleman. No profit extraction. The states that embraced toll roads in the 1990s and 2000s believed they'd found a solution to budget constraints. Raise tolls, not taxes. Let private firms take the risk. But the risk was never really private. When a toll road fails, the state often renegotiates, extends the contract, or bails out the operator. That's happened multiple times. The risk was socialized, the profits were privatized. Economists predicted this outcome in the early 2000s, before most toll PPPs were even built. So who profits? The answer is whoever holds the contract. In some cases, it's a public authority that plows revenue back into maintenance and expansion. In others, it's a private firm that extracts profit and reinvests elsewhere. And in many cases, it's both, a hybrid model where the operator profits, the state profits slightly, and the commuter pays. The model itself isn't inherently wrong, but it only works if the contract is transparent, competitive, and genuinely transfers risk, Here's what's rarely discussed: the opportunity cost. Every dollar spent on tolls is a dollar not spent elsewhere. And toll roads often exist in wealthy corridors between major cities, serving commuters who can afford to pay. Rural highways, by contrast, remain underfunded, relying on gas taxes that have been eroded by inflation and fuel efficiency. The toll model concentrates funding where it's already abundant and skips where it's scarce. That's the feedback loop. Wealth generates revenue, revenue concentrates, inequality deepens. Some states have begun rethinking toll roads. Oregon and Washington have experimented with vehicle miles traveled taxes, a fee based on how much you drive, not which roads you use. It's more equitable, less profitable to operators, and harder to lobby. Other states have doubled down on tolls, raising rates aggressively to meet debt obligations on aging infrastructure. Neither solution is perfect. Both are responses to the same underlying problem. Roads cost money, and someone has to pay. The economics of toll roads reveal something deeper about how we fund public goods. When we privatize revenue streams, we create incentives for extraction. When we dedicate revenue, we create silos. And when we mix the two, private operators, public roads, we create a hybrid that's neither transparent nor efficient. The model works if and only if three conditions hold: traffic projections are accurate, contracts are competitive, and the state retains enough control to serve the public interest. In most cases, at least one of those conditions fails. Projections are optimistic. Operators bid low knowing they'll raise tolls later. Contracts are written by the state and negotiated by the operator, not truly competitive. And the state, desperate for funding, gives up control to get the road built today. The operator profits, the commuter pays, and the road becomes a permanent tax on mobility. This isn't unique to toll roads. The same pattern appears in prisons, hospitals, and water systems, anywhere a public good is funded through privatized revenue. The incentive structure is identical: maximize revenue, minimize cost, extract profit. And the outcome is identical: the poor pay more, the wealthy profit, and the system becomes harder to change because contracts lock in decades of obligation. So, returning to the original question, who profits from toll roads? The answer is, whoever wrote the contract and whoever holds the debt. Sometimes that's a public agency serving the public interest. More often it's a private firm serving investors. And always it's the commuter who pays. The system was predictable the moment politicians decided to monetize a road instead of funding it through general revenue. And the collapse, when traffic doesn't materialize, when tolls spiral, when the poor stop driving, is equally predictable. The toll road model isn't inherently corrupt, but it's structurally incentivized to extract value from commuters and concentrate it among investors. That's not a bug in the system, that's the design. And once you see the design, you can't unsee it. Every toll you pay is a small transfer of wealth from you to whoever holds the contract. That's not a moral judgment. That's a description of how the cash flows. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand the economic incentives hidden in everyday infrastructure, subscribe. There's a new system breakdown every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.